Welcome to Inside India. I'm Shara Kang, sitting in for Sri Jegarajah. Here are your headlines. Indian markets are tipped for a muted open while the rupee hovers at a 2-month low against the greenback, with Middle East tensions and fresh tariff remarks from U.S. President Donald Trump weighing on the sentiment. Oil prices ease in Asian trade, but still at elevated levels as Israel and Iran launch fresh missile strikes at each other today. And U.S. President Trump calls for Iran's unconditional surrender. And hitting the reset button, Indian Prime Minister Narendra Modi meets with Canadian Prime Minister Mark Carney on the sidelines of the G7 summit. Both sides reaffirming ties after a souring in relations. Welcome to the program. Let's take a look at Asian markets on this Wednesday morning. And we do see a lot of nervy investors out there, and we see a mixed picture across the board there. And we do see Nikkei 225 over in Japan and the Kospi over in South Korea looking pretty resilient given despite the downside declines and moves that we see in the other parts of the region. And we've got well, what is the biggest losers there? Hang Seng Index over in Hong Kong giving up more than 1% as we speak. And of course, jittery moves, as I point out, because the Middle East conflict is raging on. Oil squarely on our radar, of course, because of that story, as the Israel and Iran conflict shows no signs of abating. Just overnight, prices shot up 4% as the Iran-Israel conflict escalated. Right now, WTI above 75, Brent crude above 76.65 as we speak. Now, the conflict entering its 6th day with fresh strikes being reported. Israeli military says it has conducted a series of strikes in the area of the capital, Tehran. Iranian media say Tehran attacked a missile production facility near Tehran as well. This taking place as U.S. President Donald Trump met his top advisors in the Situation Room at the White House just overnight. Here is CNBC's Eamon Javers with more.
We've been watching this throughout the day today, right? And obviously there are a lot of concerns about what's going to happen next. We know that the president had this meeting in the Situation Room this afternoon. What we don't know is what parameters he was looking at in terms of U.S. options, and we don't know if he's chosen anything at this hour. But I can tell you that I've been talking to high-ranking former U.S. intelligence officials through the afternoon. And there's a couple of things that stand out to them. One is that the Israelis, throughout the course of this conflict over the past several days, have shown that they have an incredible intelligence advantage over the Iranians in terms of assets in country, the ability to understand where and when Iranian officials were meeting, locations of military installations that maybe we didn't know. The United States clearly did not know how much the Israelis knew about Iran. There's clearly a delta between U.S. intelligence and Israeli intelligence. Israeli intelligence is much farther ahead than U.S. intelligence really fully understood, I think, before this conflict broke out. So what does that tell you? It tells you that the Israelis, for now, are in the driver's seat here. And the question is, does Donald Trump want to follow in the direction that Netanyahu is going, or does Trump want to wait and watch this play out and see where things are going to go? And that's a question we just don't know. It's going to be a political, economic, military, probably a psychological calculation by Donald Trump. All of that is very complicated to predict. But as we sit here right now, there is a possibility that the United States is going to get into this war.
The Indian markets come online in just about 45 minutes. And here is what Gift Nifty futures are indicating as we speak. A bit of a positivity, not a meaningful sort of a conviction trade to the upside or anything, but we do see futures edging higher at the moment. The Israel-Iran conflict was high on the agenda, of course, of the G7 leaders meeting in Canada as well. Indian Prime Minister Modi was also in Canada following a special invitation from Canadian Prime Minister Mark Carney. New Delhi and Toronto dubbed the meeting between the two leaders as the reset in the relationship, which had soured during the previous Canadian government under Prime Minister Justin Trudeau. Modi and Carney agreed to reappoint high commissioners who were withdrawn earlier. Both leaders reflected on the work that India and Canada can do together.
India and Canada's relations are extremely important. Canadian companies have invested in India in a big way. Indian people have also invested in Canada in a big way. We both stand for democratic values. Together, we can strengthen these democratic values and we can strengthen humanity.
From energy security, from the energy transition that you're helping to lead, to the future of artificial intelligence, to the fight that we have against transnational repression, against terrorism, against other factors, and the work that we can do together. And it is my great honor to have you here.
Meantime, the Indian Prime Minister also used this visit to hold multiple other bilaterals, including a sit-down with the German Chancellor. Modi also met with the leaders of Australia, the United Kingdom, Italy, Mexico, South Korea, and South Africa. Vinay Najibullah is a Vice President, Research and Strategy at Asia Pacific Foundation of Canada, joining us live this morning from Vancouver. Thank you so much for joining us, Vinay. So a lot of analysis done on this extended guest list for the G7 Leaders Summit this time around, specifically on India. Do you think that this can be a meaningful reset between India and Canada? It's been tense 2 years, difficult 2 years for these two countries' bilateral relationship.
Yes, today was a really important day in Canada-India relations. It was important for Prime Minister Carney to invite Prime Minister Modi to Canada. The decision was a difficult one. There was some pushback from certain segments here in Canada, but nonetheless, he moved ahead because of both significance of India as a rising power, as an important voice for the global South, as the fifth largest economy, as the fastest growing economy. All of those factors led to the fact that Prime Minister Carney invited India to the G7 and then had this bilateral meeting, which by all accounts was positive, constructive, and in some ways set the foundation to begin to rebuild the relationship. It is a political moment for a reset. The new government, as well as the changes led by President Trump, have created this political opening, but we still need to do a lot of work to rebuild the relationship.
That's right. And, 2 tense years, of course. I mentioned that because of course, the former Canadian Prime Minister Justin Trudeau's accusation of the Indian government's involvement in 2023 in the killing of a Canadian Sikh separatist. This is going to be a political, story, as you point out. And do you think that they actually have some sort of a meaningful willingness to navigate this political fallout because of bigger issues at hand, of course, which is the geopolitical trade relations?
Yes, so I think certainly Prime Minister Carney, both in his readout, but also in the press event that he held at the end of the G7, noted that there is a commitment on both sides to have serious conversations about law enforcement, about issues of foreign interference, transnational repression, organized crime, terrorism. There are serious concerns on national security on both sides, and they have to be dealt with. And we need political leadership to signal that other officials need to seriously engage on those issues. So I think this has been an important 24 hours in Canada-India relations. The foundations, the baseline has been set to begin those more difficult conversations, but that work needs to now continue. It's not going to be automatic. There are serious issues that need to be resolved, but there are also a lot of opportunities in this relationship. And that is what I think both leaders wanted to stress. Canada and India have complementary economies, a ton of potential to deepen trade and commercial relations. There's also a lot that can be done on critical minerals, on energy security, on technology and investment. So there's a lot of potential in the relationship, but it will take some political leadership and hard work to rebuild the relationship.
And you probably just went through all this in your answer just now, but how does this really reflect India's growing global stature, if you want to call it that? Obviously, India was seen for many years as a China plus one strategy for a lot of these countries. And sure, it's not exactly the first time for G7 to extend the invitations in their outreach program, but certainly in 2025, it garners even more attention.
Yes, I mean, India has been invited to a number of G7s. India has been consecutively invited every time since 2019. And I think it would be fair to say that most likely next year, if there is a G7 meeting in France, India will be again invited as an important partner. For Canada-India relations, it's also important to use this G7 moment, and that's exactly what happened, to be able to make progress on the bilateral relationship as well, but also to do things together in the Indo-Pacific region. Canada has an Indo-Pacific strategy. India is an important player in the region, as you mentioned, to balance China's rise and more assertive behavior, but also to have relations with others in Southeast Asia. So I think Canada and India can do a lot together in the region as well as bilaterally.
Since we're on the trade angle here, Avina, India and UK striking a trade deal after more than 3 years of negotiation. Was there any takeaway for you in terms of how we should view the future of the U.S.-India trade deal or the future of India-Canada trade relationship?
Absolutely. The fact that India is now much more open to these kinds of trade agreements, that it's negotiating a comprehensive trade agreement with the European Union, that it has concluded one with the UK, that it's also negotiating one with the US, these are all significant developments and hopefully would pave the way for Canada, India to be able to restart the discussions on the free trade agreement between our two countries. Historically, it's been difficult to negotiate trade agreements with India. India is much more protectionist, but I think we are now living in a new moment, and President Trump and his disruptive trade policies are forcing countries, Canada included, to seriously look at diversifying trading partners and economic partners. And that's, I think, is going to bode well for what could happen between Canada and India as well.
And going back to somewhat socio-cultural angle in this bilateral relationship, just because there is this huge community of Indian diaspora in Canada, how could that influence the future trajectory of India-Canada relationship after this G7 meet?
Yes, so obviously people-to-people relations are quite significant. We have a very large Indo-Canadian community, as you mentioned, a diverse one, and many of them want to have better relations between Canada and India to be able to facilitate travel, to facilitate business and exchanges. There's also a difficult issue when it comes to the diaspora, and that has to do with Sikh separatism and the Khalistani issue, which has been a source of a lot of challenge in the relationship. So that is also important to note. But I think overall, there is a strong desire and need on the part of both Canada and India to strengthen relations, to improve relations, to be able to allow also the large community of Indo-Canadians to be able to travel, to have visas, to be able to do business in each other's countries.
How do you see the future of India-Canada relationship playing out while they are trying to navigate their own bilateral trade relationship with the United States? And this is one big variable, but do you see India and Canada perhaps ramping up their trade volume in a more meaningful way going forward?
Yes, so U.S. will remain the most important economic partner for Canada. And of course, India also very much prioritizes its relationship with the U.S. So both countries will focus quite a bit of their attention in getting a deal with President Trump. But I think on the margins of that, in building on this successful G7 bilateral meeting between the two leaders, I think Canada and India can make progress and begin to have conversations on deepening economic and trade relations. At this G7, the two leaders mentioned areas where that could happen. So green energy, critical minerals, investments, supply chain resilience. Those are some of the areas where I think progress can be made. And hopefully discussions will start in soon order. The fact that we now have a commitment to reinstate or to appoint new high commissioners is a good sign, because we need people on the ground in each other's countries to be able to engage in diplomacy and move these discussions forward.
And I don't mean to sound too cynical about it, but, to what extent do you think that this is really just driven by pragmatism, because they need each other, because of Trump's tariff, high level of tariff pressure, that they just somehow need to ignore this bilateral tensions that's really stressed the bilateral relationship for the last couple of years?
It's a fair question to ask, but I don't think that either side, and certainly Canada, can't ignore the tensions in the relationship. There does need to be some kind of a process to deal with that. But at the same time, you're right, there's now a desire to be more pragmatic and to diversify economic relations in an era of trade disruption and tariffs that has been unleashed by President Trump.
Veena, it's great to have you on. Thank you so much for joining us this morning and your evening. Of course, Veena Najibullah, Asia Pacific Foundation of Canada. Coming up on the show, oil's fluctuations, a hot topic at the ongoing Energy Asia conference underway in Kuala Lumpur. We'll take you to the Malaysian capital and bring you an exclusive interview with the chairman and CEO of French energy giant TotalEnergies. Inside India is coming right back. French energy giant TotalEnergies has been ramping up its India plans JP Ong is in Malaysia and got a chance to speak with the company's CEO on the sidelines of the Energy Asia conference there. JP, tell us why India is so big on TotalEnergies' agenda.
Well, good morning to you, Sherry. And yeah, I mean, it is one of those target markets that TotalEnergies is actually looking at. It also dovetails and works quite closely with TotalEnergies' own shift away from hydrocarbons and also leaning more on natural gas as a possible transition fuel. Look, it's pretty clear to see that there are a lot of high growth areas still in the Asia Pacific, including that of India, which remains one of the highest growing and fastest growing economies in the entire world. But to power that growth, you'll need a lot of energy, but you'll also have to do it in a cleaner fashion because of some of the climate accords and some of the climate change agreements that have been signed by countries like India. So how you were able to provide energy at a big clip actually to support the countries like India and other countries in South Asia will actually be quite important. And because of that, we've seen the likes of TotalEnergies actually pivot more towards Southeast Asia and actually enlarging their operations and their production of natural gas to supply these many areas. Patrick Pouyanné, the CEO of TotalEnergies, did say that the shift to from hydrocarbons continues to be an important goal for TotalEnergies, but that natural gas plays a very important role, not just in terms of facilitating that transition, but also meeting the demand for cleaner energy across this part of the world. Here's what he said.
Asia, for us, it's a big market. You know, it's the growth in gas, the growth in oil is coming from Asia. It was China, India, and Southeast Asia, ASEAN countries are where the economy is growing quicker. Gas is very important in that region because it's an alternative to coal. So we strongly believe that there is most of the LNG demand is coming from Japan, Korea, Taiwan, Vietnam, tomorrow, India, etc. So being in Asia is important. It's true that you don't have a lot of natural resource. We were historically in other countries, Indonesia, Thailand, and we decided, because of importance of Asia, we had the opportunity in 24 to come back in Malaysia, to establish ourselves in Malaysia. Malaysia is a stable, I would say, offers a good, stable framework from an economic point of view, a very prolific basin in terms of natural resource and gas in particular. So we acquired some assets last year from Sapura OMV, and I'm very pleased because I came for the first time in Malaysia as a CEO in 23. We acquired these assets in 24. And this year in 25, we have announced a big I would say, a strategic partnership with Petronas, where we'll acquire, again, a number of blocks, including some new gas resource to be developed, and again, some exploration as well, which is important. The region for us, TotalEnergies is the third largest LNG company in the world. Of course, it's LNG because we strongly believe in gas, in LNG, and we see again these Asian markets as a core of our strategy from this perspective.
And just to double down also, because you're one of the few oil and gas companies that are still sticking to your commitments to shift away from hydrocarbons to electrons, but you've mentioned that the decarbonization has to be done gradually. How gradual do you think that has to be given the state of things right now?
The customer will decide.
Okay.
You know, it's the customer. The transition will go with customers. In fact, we are not shifting away. We have two pillars. One is oil and gas, and we bet a lot on gas. Today, we were 10 years ago 50% oil, 30% gas. Today, we are 40-40. And what we want to add on it, it's electricity. In fact, the other strategic decision from in 2020, when Total became TotalEnergies, is to produce electrons on the top of oil and gas. Why? Because electricity is the energy of the 21st century. We speak about AI, data centers, you need more electricity. You speak about EVs, it's electricity. You speak about decarbonization, it's electrifying the process. So we strongly believe in the growth of electricity. I don't know at which pace it will replace oil and gas. What is clear is that oil and gas today have a limited growth. It continues to grow because the population is growing, in particular in Asia. But so we have two pillars in the strategy. We continue to deliver to customers the energy of today because oil and gas is affordable. And we are investing a lot in electricity. And in fact, in 2025, electrons will represent more than 10% of our sales and production. So we are becoming, will be an oil and gas and electricity company. And it's, I would say the strategy is the energy of today that you use every day. and the energy of tomorrow, which will be more and more electricity. This is what we want to do. And so it's not only climate change, it's just, in fact, the trend, which is linked to evolution of the demand. Again, electrification of the use will be the big trend of the 21st century. And I just spoke about AI. We need more data centers. All that is much more electricity.
And the trickiness of energy transition, Sherry, is most highlighted by India's context. There's a massive and fast-growing economy, but it's mostly powered right now by fossil fuels. So transitioning to cleaner fuels and more renewable sources will be tricky because of the magnitude and the scale of India. Thus, the proposition right now is to transition towards cleaner fossil fuels like natural gas as you're building up the capacity for renewable sources right now, and to move towards electrification. Again, a tall task, a lot of moving parts, a lot of big steps you need to accomplish. But again, they do see, at least Total Energy sees, that gas could play a vital role in helping India make sure that they can sustain and feed that strong economic growth while doing it in a cleaner fashion.
Yeah, and this week, JP, on the ground there at the conference, you've been speaking to a lot of industry leaders out there. I mean, tell us what you're hearing about this oil price volatility. I mean, what are you hearing? What is the biggest takeaway for you in terms of how much of a geopolitical risk premium makes sense at this point?
Yeah, that's a great question, Sherry, and something on the minds of many of these energy executives here at the Energy Asia Summit, how you're going to deal with this massive volatility that they've actually seen unleashed just in the last 7 days from the Israel-Iran conflict. On one hand, they have said that you cannot really control volatility. You can only focus on what's actually under your control at the moment. But something interesting that Patrick Pouyanné actually mentioned also, and he did remind me that the role of an energy CEO is not to try and control the price volatility we've seen in the last couple of days. You can only focus on what's under your control, and that the key thing for them right now is to make sure that they can lower the cost or the break-even cost of with regards to production of oil and gas to try and at least mitigate some of these shocks that they're trying to deal with. Currently, he says that Total Energies has it at about $25 per barrel and that they want to improve that. He does say that it's good for the margins to have oil high, but right now the only thing they can really do is try to lower the cost side of things. And also just a reminder as to why Patrick Pouyanné is a global energy CEO and I'm not. Sherry, back to you.
Well, be nimble and lower the cost. A big takeaway. Thank you so much, JP, for that. Coming up on the show, we'll track what's moving the Indian markets amid multiple risk events, including the conflict, of course, in the Middle East and the Fed's decision tomorrow. Stick around. You're watching CNBC. We are counting down to the market open in India, and this is how we are shaping up this morning. Of course, we're watching the oil spike and what's going on in terms of the currency market as well. Gift and Nifty futures actually edging higher as we speak, and we've got the dollar rupee edging higher. So yet another leg higher for, of course, on the Middle East tension story and oil spike as well. One of the biggest stories that the markets were watching for some time has been Indian markets regulator SEBI giving its nod to move equity derivatives expiry days. The National Stock Exchange of India will see contracts expiring on Tuesdays, while for the Bombay Stock Exchange, Thursday has been fixed as the expiry day. The new expiry day contracts will start from September the 1st. In an interview with us last month, the chairman of SEBI, Tuhin Pandey, had told us the reason behind shifting these contracts.
I think we had an excessive retail activity on some of the products like index options only on the expiry day. The rest of the future options are in any case going on. And on the index options weekly expiry day, we had an exuberant activity on the expiry day, which was creating some distortions. I mean, to that extent that, they have been losing money, and which is our study report pointed out over the last few years.
SEBI is also holding its first board meeting of fiscal year 2026 today to review reforms and regulatory transparency. And let's get a check on Indian bond yields as well. IGB's tapering off the rally a bit. That was mostly sparked by the RBI governor's dovish comments on policy rates. We're also awaiting the Fed decision, of course, that is tomorrow. While most analysts expect the FOMC to stand pat on rates, their macro forecast could see big changes. CNBC's Steve Lisman has findings from the June CNBC Fed survey.
Despite improvement in the economic outlook, respondents to the June CNBC Fed survey continue to forecast weaker growth and higher inflation than they did at the beginning of the year, and still elevated tariff uncertainty. 100% expect no change at the meeting this week, but the recession probability has dropped to 38% from 41% in mid-May and 53% in earlier May. 3.9% is the expectation for the funds rate in 2025. That incorporates 2 rate cuts this year, but only 1 rate cut expected next year, with the funds rate dropping to 3.55. And that means that the Fed is expected to remain above neutral, or the 3.3% neutral rate, to the end of 2026. The forecast for GDP did tick up a little bit to 1.13% compared to 0.8% in May, but that compares with 2.4% expected in January. In 2026, the U.S. economy is seen bouncing back even above trend at 2.2%, a bit above the 1.9% from May. Doug Gordon, senior portfolio manager with Russell Investments, writes in with the survey, recent geopolitical events in the Middle East add uncertainty into an already uncertain environment on trade, tax policy, and with potentially weakening hard macroeconomic data pending. The outlook for inflation improved a bit for 2025, down to 2.95% from 3.24% in May, and 2026 down even more to 2.58%. The unemployment rate also improved a bit, but still seen ticking higher to 4.5% this year and around the same for next year. Mark Vittner, chief economist at Piedmont Crescent Capital, says the economy has remained resilient, not terrified. There's no shortage of reasons to worry, he says, but the U.S. economy keeps proving its doubters wrong. On a separate note, more volatility could be ahead, with most expecting an early announcement of Fed Chair Powell's replacement. 64% believe the president will appoint a replacement for Fed Chair Powell by the end of the year. 21% say he will not. 14% are unsure. Meanwhile, most respondents forecast that price increases from tariffs are coming, but the good news may be that at least some think they will be just one-shot deals when it comes to inflation. A slim 43% plurality say tariffs will result in just a one-time price increase. 32% worry it will lead to a broader inflation problem for the Fed. 11% see no significant change, and 14% they just don't know. And forget the recent benign inflation reports, because 61% believe tariffs are going to show up in the future months, quote, more significantly, while 36% look for them to have only a modest impact on prices in the months ahead. The timing and magnitude of the tariff impact is key to the Fed outlook, and a majority believe the Fed will feel confident enough in inflation or worried enough about the economy to cut come September. Steve Leisman, CNBC Business News.
Shibani Kurian is head of equity research at Kotak Mahindra AMC. Shibani, it's great to have you on. Thank you so much for joining us this morning. So certainly investors on edge feel like we're sort of flying blind right now because we just don't know how the Middle East situation is going to play out here, and not to mention, and let's not forget, trade tensions as well. How are you feeling overall about the Indian equities market at this point in time?
Hi, and a pleasure to be on the show. So for Indian equities, it's been a mixed bag. On one hand, as you rightly pointed out, there are uncertainties relating to the trade and tariff issues, and then the geopolitical conflict in the Middle East. So therefore, there is volatility that Indian markets are having to navigate along with the world markets. But if you just take a step back and see what's happening on the domestic macro front, actually macro parameters in India have been holding up fairly well. Growth seems to have bottomed out sometime in the second quarter of last fiscal and has seen improvement, especially when some of the high-frequency economic indicators are concerned. Policy has been fairly supportive. RBI has cut policy rates by 100 basis points this calendar year, as well as the fact that the budget has given some amount of tax benefits to the lower income population. So in that context, when you look at our markets and you look at the earnings trajectory for corporate India, FY25 was a muted year, but the expectation is that from here on, we should start seeing improvement as far as corporate profitability goes and earnings goes. However, valuations are not exactly cheap. Indian markets have bounced back from the lows. And in that context, we believe that near-term volatility is here to stay, but large caps appear to be relatively better placed from a valuation perspective.
So you sort of gave us a very good comprehensive layout of what's going on in the Indian market. But let's talk about this potential RBI put that the governor actually put in just a couple of days ago. And in an interview talking about some of the discussion points from the post-June meeting discussion points, he talked about opening up a policy space even more. Of course, inflation needs to behave right. But do you think that October meeting could be a live one, yet another cut on the horizon for the markets?
So if you look at what happened at the policy meeting, the last policy meeting, the stance was changed from accommodative to neutral, which means that from here on, any further policy decisions on the downside in terms of cuts will clearly be data determined. So far, inflation in India, which is the CPI inflation, has been tracking well below RBI's target level, which is 4%. And we expect that to continue even in the months going forward as well. And therefore, if inflation does stay low, there is still room to cut, but it will predominantly be data-driven, as what was indicated by the change in stance. What we also have to understand is, along with the 100 basis points of policy rate cuts, there was 100 basis points of CRR cut, which infuses liquidity on a more structural basis as far as the economy goes. And therefore, I think the focus of monetary policy at this point in time is to get growth back on track. Credit growth in India has been hovering around that 10% mark. And therefore, the focus of policy is essentially to provide adequate liquidity as well as policy space for overall credit growth and hence GDP growth to get back on track.
But just because we're watching the situation between Israel and Iran, and I mean, this is a big energy story for the most part, at least given the market reaction so far. And a big energy story is going to be a big story for India, given how it's such a big oil importer as well. Then does that somehow constrain the policy tools that the RBI has?
Yes, absolutely. So this is something that RBI will possibly be watching out fairly closely. As you rightly pointed out, India being a large importer of oil, energy prices do have a bearing. In fact, the rough math is that with a $10 increase in oil prices, current account deficit rises by 50 basis points, everything else being equal. And therefore, from a macro perspective, oil prices do have a large bearing. However, the good part is that as long as oil stays between $70 to $80 a barrel, we are still fine on macro. The second aspect is that our forex reserves have gone up considerably, and that gives RBI a lot of cushion to manage currency volatility. And thirdly, as we were discussing, the domestic macro parameters seem to be holding on and stable. So as of now, inflation trajectory, given that food inflation has come off considerably, monsoons are likely to be normal. Inflation trajectory should remain below RBI's projected levels and the comfort level of 4%. And therefore, that gives RBI the room. But as you rightly pointed out, what's happening geopolitically and its impact on commodity prices and oil is an ever-evolving situation, and that's going to need close monitoring.
So, Shivani, you just said that $75, $76, that's okay. Is that what you meant? Or so what is the level that we should be worried about? And the duration would matter, right? So are we talking like $100 and staying in that range for 3 months? That would have an impact. I mean, India could be a special case in all this. But what is the level you're watching and what is the duration that you're talking about?
Absolutely. So as I mentioned, anywhere between 70 to 80 as a range still is fine for Indian economy and macro parameters. As oil moves, when oil moves above 80 for a sustained period of time, of course, anything above 80 would, for a long period of time, would have an impact as far as both inflation as well as the current account deficit goes. But as I mentioned, as of now, when we are in the middle range of about $75, $76 a barrel, we are still fine as far as the various macro parameters go.
And you briefly mentioned the valuation part. So do you think because of the rally in Indian market since the early April market meltdown, that valuation for the most part has caught up again? And what's going to be perhaps the catalyst that could give the Indian stock market another leg higher from this level?
Yes, so absolutely. So when markets have bounced back from the April lows, valuations have caught up, especially when you look at the mid and small cap segments. Valuations, if you look at vis-a-vis its long-term average multiples on a one-year forward price to earnings, multiples are, at a almost 20 to 40% premium for mid caps and small caps respectively. For large caps, it is at a slight premium to long-term average multiples. And hence, yes, valuations have caught up. And in that context, as we were saying, risk reward is more favorable for large caps as compared to mid and small caps. For the next leg of multiple re-rating, clearly earnings trajectory has to improve. FY25 was a muted year for corporate earnings. Nifty earnings was mid-single digit. Expectations of FY26 is of double-digit earnings growth for the Nifty, which is the large cap index. If earnings trajectory does improve, and remember we do have a favorable base, rural demand is starting to show signs of improvement and policy support. So therefore, the biggest catalyst in our view for the markets, apart from flows and sentiment, would be the earnings trajectory for corporate India.
And, right at the top in the setup for you, we mentioned of course, the currency factor in all this as well. And we've got, of course, the dollar getting a leg higher versus the Indian rupee, given the oil price related concerns as well, Shibani. So how does that impact the equity side of the story?
So absolutely. So currency does have a role to play, especially as far as, the FII flows are concerned. As we were mentioning, India, of course, is not an island, and therefore India does get impacted with what's happening geopolitically, as well as movement in oil prices and the like. So to that extent, when we look at our currency markets. The couple of factors today, when you look at the current account deficit on a more fundamental basis, current account deficit is fairly well under control. RBI does have a large forex reserve which they can utilize for managing currency volatility. Having said that, given that geopolitical tensions are abound and there is uncertainty on trade and tariff, it is likely that the buyers for currency would remain on the depreciating side. But there are enough tools from a policy perspective to manage significant volatility as far as currency goes.
And is there any sectorial breakdown that you can give us? Avoid a certain stocks because of the, of course, oil as well as currency environment that we're in India, and these are the sectors that you really prefer?
Absolutely. So our preference has been towards sectors which derive demand from the domestic economy. Our belief is that given what's happening globally in terms of trade, geopolitics, as well as slower growth, India, from a growth perspective, still stands out and continues to be among the fastest growing large economies of the world. And therefore, sectors that derive demand from domestic economy are better placed. In that context, segments such as banking and financial services, which gets support because of the policy side, as we were discussing. And the second segment is discretionary consumption, which again gets a boost because of the policy initiatives, both monetary and fiscal. These are some of the segments that we are positive on. Where we are cautious, of course, are segments which are more global in nature, commodities and the like. And therefore, from a portfolio tilt perspective, more bias towards domestic facing sectors such as banks as well as discretionary consumption.
And when you say banks, I mean, so my next question was going to be, India's central bank reducing CRR, so cash reserve ratio. Is that already playing out in the market? When do you see the impact coming through for the equities?
So there are two parts to the impact of policy action as far as banks go. With policy rates coming down in the initial phases, as the lending rates reprice along with the repo rate, there will be some degree of pressure as far as net interest margins of banks go, which will possibly be seen in the first quarter of FY26. On the other hand, with RBI cutting the CRR or the cash reserve ratio, as well as banks bringing down their deposit costs and deposit rates, margins should start to improve, especially into the second half of the year. So therefore, the margin trajectory and profitability of banks will initially see some impact in the first half before improving in the second half. More importantly, as we were discussing, from a valuation perspective, Indian banks still trade at long-term average multiples with a better return on equity profile as compared to what it was 5 years ago. And therefore, valuations mean that risk rewards are clearly in favor for Indian banks at this point in time.
Shivani, it's great to have you on. Thank you so much for your time and insights this morning. That was Shivani Korean from Kotak Mahindra AMC. Have a great day ahead. Some updates on the investigations into Air India's 787 Dreamliners after the fatal crash last week. The country's aviation regulator says it has found no major safety concerns in the airline's fleet of Boeing 787s, adding that they were found to be compliant with existing safety standards. The surveillance comes as multiple Air India flights faced cancellations. Some reported technical snags mid-air. Majority of these aircraft were Boeing Dreamliners. Air India also says it is facing operational issues, including unavailability of aircraft. Indian markets have joined the trading day. We'll look at some early movers after this quick break. We're back in 2. And this is just coming through on, of course, flashes. And before we get to the Indian markets, we've got India's Foreign Secretary's office saying that India's Prime Minister Modi actually held a 35-minute-long telephonic conversation with U.S. President Donald Trump here. We don't really have a lot of details, but of course, I would imagine this is just a catch-up because President Donald Trump decided to leave the G7 leaders summit earlier than scheduled, so they couldn't talk in Canada in person. So they're getting some phone conversation in here. And let's move on to the markets. And of course, the Indian markets are coming online just moments ago, and the Nifty 50 as well as the Indian rupee very much in, just sort of a directionless kind of a kickoff here. As you can see, the Nifty 50 trying to decide the direction for the day, and the same goes for the currency board as well. Quick check on some of India's pharma stocks this morning. And of course, President Donald Trump is digging in his heels on the pharma sector on his way back from the G7. Trump said pharma tariffs are coming very soon. We can see a mixed picture for the sector at the moment. Negativity does dominate the board there. The U.S. is, of course, one of their biggest export markets for many Indian pharma giants who mostly supply generic drugs. And Hindustan Zinc is on an expansion drive, approving a project worth nearly $1.4 billion to ramp up capacity. India's top zinc producer says it aims to set up a metals complex with a capacity of 250 kilotons per annum in the northern India state of Rajasthan. It also expects annual revenues of 620 to 650 billion rupees at peak capacity. The newly approved project is due for completion in about 3 years. The stock is actually giving up close to 6% as we speak. Meantime, in separate remarks, CEO Arun Misra says Hindustan Zinc is also interested in mining rare earths. And one final check on Asian markets. We've got, of course, a lot on investors' minds, and we do see some comeback for some of these markets. So we've got more green on the wall there, but as you can see, Hang Seng Index over in Hong Kong is giving up some points, in fact, more than 1% as we speak. And we did see some figures from Japan earlier this morning. That data came amid trade negotiations between the U.S. and Japan. Our Lin is joining us to make sense of it all. Lin.
Yeah, hey, Sherry. So the data is pointing to signs that Japan's export picture is deteriorating, with exports falling for the first time in 8 months, although the fall was less than expected. We focus in on the US market. This is the #1 market for Japan's exporters, with shipments to the US falling by 11%, and auto shipments in particular falling by close to 25%, although it is worth noting that that is 25% in value terms, but by volume only falling by about 4%. That's suggestive that for the automakers, we are seeing price cuts to keep up those shipments, and that's something we actually saw early signs of in April as well. As I said, this is a key market for Japanese automakers. Vehicle exports make up about 25% of all exports going into the US. And of course, this is coming as we are seeing that in terms of the trade talks between the two countries, it remains at an impasse. We heard from the Japanese Prime Minister today basically saying that whilst Japan does want a trade deal with the United States, that they are not willing to sacrifice their own national interest. And in particular, he highlighted the pain that Japanese automakers are experiencing. And, seeing the responses from economists to this data, the expectation is that it will only worsen, especially as the reciprocal tariff pause will end in early July. Sherry.
Thank you very much, Lynn. And certainly shows how tariffs are weighing on these numbers, and it's just getting started. Thank you very much, Lynn, for that. And that does it for this edition of Inside India. But to stick around for CNBC Access Middle East is coming up next.